Today I'm going to show you what a lender's rate sheet is, what it looks like, and how it works. So a lender's rate sheet shows a lender how much money each available interest rate either costs or pays. The cost, or that credit, may be represented in dollars, but it's usually represented in points. 1 point equals 1% of the loan amount. So if you have a $500,000 loan, 1 point equals $5,000. Let me show you a simplified illustration. Now, these are not actual rates. I am not a lender. This is just to show you kind of how it works. This scenario is a $500,000 loan. So what you can see here is that there are a variety of different rates available, all the way up to 4% and all the way down to 2.5%. As I said before, if you want to get this lower rate, there's a higher cost. And I've taken the rate sheet here that shows you what percent or how many points it costs to get this particular rate. And in this case, to get a rate of 2.5 today, this sample says it would cost you 3.56 points. On a $500,000 loan, that translates into $17,800 in upfront costs just to get that rate. Now, to get a 4% rate, if you took a 4% rate, they would actually pay you 2.235 points, or the equivalent of $11,175 upfront to you to take that worse rate. When a lender talks about par rate, they're looking at one of these two rates right here. Sometimes there's an actual 0.000 points, since there's no points, there's no credit, and sometimes that happens, and that's what you would consider the par rate. But typically, the lenders will quote you the lowest rate that doesn't give any money back to you. Or I'm sorry, the lowest rate that doesn't cost you anything. So in this case, par rate today in this scenario would be 3.25. So a 3.25 interest rate. And that's because it doesn't cost you anything to get that rate. In this scenario, again, that 0.105 points credit that they're giving you means that they'll give you $525 to take that rate. If you were to go up or go down to the next rate of 3.125, it would actually cost you $1,165 in this sample, in this scenario, to get that rate. So what most buyers don't know, they're often told about the par rate or what it would cost to buy that rate down. But what most buyers are not shown is, what if I took a slightly worse rate, slightly higher rate? How much money would you pay me to take that rate? In this case, for example, if they were to choose, instead of 3 1/8, they were to choose 3 3/8, they'd have $2,545 that they could use toward their closing costs or fees. If they were to take 3.5%, almost $4,000 could be applied toward those upfront costs. So this is just a simple illustration to help you understand two basic principles about mortgage loans. First, there are many rates available. In theory, you could say any rate is available. And second, rates either cost money or they pay money. Now, rate sheets are actually much more complex, and they're pretty cool if you can get excited about numbers. And in the next video, we'll talk about the various products, programs, terms, and adjustments contained on rate sheets. For help finding a real estate professional in your area, visit reprelocation.com today.